As we stand here right now, observing the markets on this Sunday, November 30th, 2025, the trading desks are quiet and the tickers are frozen in place. The Nasdaq is closed for the weekend, locking Plug Power Inc., ticker symbol PLUG, at a closing price of $2.01 per share. That figure, $2.01, represents a closing upward movement of 1.52%, or roughly 3 cents, during the final hours of the last trading session. If you are opening your Fidelity mobile app or checking your holdings on the Robinhood app right now, that is the number staring back at you. It is a price point that looks deceptively calm, a flat line on a weekend chart. But do not let that stillness fool you. Beneath that $2 handle lies a battlefield of conflicting narratives, massive institutional maneuvering, and a retail investor base that is currently holding its breath. The expectation right now, the story that many aggressive growth investors and those utilizing Schwab intelligent portfolios to diversify into green energy want to believe, is that we are looking at a coiled spring. The narrative is that hydrogen is the inevitable fuel of the future, that the worst of the cash burn is behind us, and that a stock trading at $2 is a generational discount similar to buying Tesla stock before its initial massive run-up. You look at the chart, you see the history of volatility, and the natural human instinct is to think rebound. However, the reality we need to confront today is far sharper and less forgiving. The reality is that Plug Power is currently navigating a liquidity minefield that has little to do with the green energy dream and everything to do with the harsh mechanics of high-interest financing and government policy shifts. We are not just looking at a cheap stock, we are looking at a company that has recently suspended activities related to a massive Department of Energy loan guarantee. A move that fundamentally alters the risk profile for anyone holding this equity. The gap between the hydrogen future expectation and the cash crunch reality is where your money is either made or lost, and that is exactly what we are going to tear apart right now. When you analyze the trading volume that led us to this $2.01 level, you see a distinct tug of war. On one side, you have the retail army, traders active on SoFi Invest and Robinhood fractional shares who see a low absolute dollar amount and buy in, assuming that the only direction from here is up. It is the same psychological trigger that drives volume in penny stocks, yet Plug Power is a company with a multi-billion-dollar market cap and global infrastructure. On the other side, looking at the order flow from major desks like Interactive Brokers or institutional heavyweights, you see a different story. The institutional activity isn't betting on a bounce, they are hedging against dilution. This stock has become a proxy for the entire speculative energy sector. When interest rates tick up even slightly, or when news breaks about the One Big Beautiful Bill Act rolling back subsidies, the algorithms hammer PLUG harder than almost any other name. It is not trading on fundamentals right now, it is trading on macro fear. Let's discuss the immediate catalyst that is driving this price action. Just days ago, we saw the fallout from the Q3 2025 earnings report. The headline numbers were a mixed bag that confused the market, leading to this consolidation around the $2 mark. The company reported a loss of 12 cents per share, which technically beat the expectation of a 13-cent loss. In the world of high-growth tech, a beat usually triggers a rally. But look closer at the revenue. They brought in $177 million, missing the forecast of $187 million. This tells us that demand is not ramping up as fast as the cost-cutting measures are taking effect. The market hates uncertainty, and a revenue miss suggests that the adoption curve for hydrogen fuel cells is flattening out right when the company needs it to accelerate. But the real story, the one that isn't in the headlines of your standard investment newsfeed, is the cash position. Plug Power has been burning cash at a rate that has terrified credit analysts for years. In this most recent quarter, they managed to reduce their net cash used in operating activities to about $90 million. To a casual observer, that sounds like a lot of money to lose in 3 months, and it is. But compared to the nearly $600 million they were burning in similar periods a year ago, it's a massive tightening of the belt. This is the Project Quantum Leap restructuring in action. They are cutting costs, slashing inventory, and trying to stop the bleeding. The question you have to ask yourself, and I want you to really think about this, is, are you investing in a company that is growing or a company that is shrinking itself just to survive? There is a massive difference between a growth stock and a distress play, and Plug Power is currently straddling that line. This brings us to the elephant in the room, the Department of Energy loan. For the better part of a year, the expectation was that the DOE would finalize a $1.66 billion loan facility that would act as a backstop for Plug's expansion. It was the safety net that allowed investors to sleep at night. But recent reports indicate that Plug Power has suspended activities related to this loan. Why? Because the political winds have shifted, with the incoming administration signaling a hard pivot away from green subsidies and towards traditional energy dominance. Plug Power management realized that relying on that loan was a binary risk they could no longer afford to take. By pausing it, they are trying to pivot to private financing and alternative capital raises. This is why you saw the stock drop 33% over the last month before stabilizing here at $2. The safety net is gone. The company is now walking the tightrope without a government harness. This reality check is painful, but it is necessary for the stock to find a true bottom. While we're on the topic of holding through volatility, I want to hear from you. Comment below how many shares of Plug Power you currently hold, and more importantly, what is your average buy-in price? Are you averaging down at these $2 levels, or are you holding a bag from the $20 days? The disparity in cost basis among shareholders in this stock is one of the widest in the market, and it creates fascinating psychological resistance levels on the chart. Now, let's pivot to the business itself, because amidst all this financial engineering, there is actual hardware being built. Plug Power is not just a concept, they are the leaders in the hydrogen ecosystem. They build the electrolyzers that split water into hydrogen and oxygen. They build the liquefaction plants that turn that gas into a transportable fuel. And they build the GenDrive fuel cells that power forklifts for giants like Amazon and Walmart. The core business proposition is sound. Battery electric vehicles, like Tesla stock represents, are great for passenger cars, but they are terrible for heavy industry. If you have a fleet of forklifts running 24/7, you cannot afford to have them sitting at a charging station for 3 hours. Hydrogen fuel cells refuel in minutes. That efficiency gain is real money for logistics companies. However, the problem has always been the cost of the hydrogen itself. Plug Power set out to build a green hydrogen network, producing the fuel themselves to sell to their customers. This was the grand vision, the vertical integration that would make them the Exxon of the future. The reality has been that building these plants, like the ones in Georgia and Tennessee, are hideously expensive and prone to technical delays. The Georgia plant is running, and that's a major technical achievement, but the margins on the fuel are still under pressure. They are selling fuel often at a loss or break-even to keep the customers using the fuel cells. It's a classic razor and blades model, but the razor blades cost a fortune to manufacture. This structural difficulty has forced the company to look for new narratives, and the latest one is artificial intelligence. You might be wondering, what does a hydrogen company have to do with NVIDIA stock or the AI boom? The answer is power. Data centers are consuming electricity at a rate that the current grid cannot support. We are seeing a desperate scramble for on-site power generation. Plug Power has recently teased partnerships to use their stationary fuel cells to provide backup and prime power for these massive data centers. If, and it is a massive if, They can secure a major contract with a hyperscaler to power a server farm with hydrogen. The narrative shifts overnight. It moves the stock from a struggling green energy play to an AI infrastructure play. We have seen stocks double on less news than that. But as of today, November 30th, that is speculation, not revenue. It is an expectation, not a reality. Let's look at who is actually holding the bag here. Institutional ownership stands at around 40%. Vanguard and BlackRock are there largely because Plug is in every clean energy ETF. If you own a clean tech ETF in your Fidelity IRAs or your Schwab account, you own Plug Power whether you know it or not. But the retail ownership is over 50%. This is incredibly high for a company of this size. It means the stock is susceptible to emotional swings, panic selling, and meme stock rallies. It means that technical analysis often works better than fundamental analysis here because